If you have a whole lot of money in the bank, that's actually could be a bad thing. You have a real problem. What am I talking about? I'm talking about something called inflation. What that means is that if your money is not making at least a minimum amount of return to keep up with the times, that ugly thing called inflation is going to beat your savings down to nothing. Not good. How do you fix it? You start by giving yourself an education of what your alternatives may be. If you walk into a bank, they're going to greet you with a big smile, and they're going to tell you they've got different accounts for you. And they do. They've got money markets, they've got CDs, they've got checking accounts, and of course they've got the guy sitting back in the corner that does other stuff. But let's just focus on the bank stuff, okay? A lot of people have their money in the bank. Why is that? The number one reason why I hear people keep a whole lot of money in the bank is because they say it's safe. A lot of people think that the bank is safe. Now, don't get me wrong, there's nothing wrong with having some money in the bank. I mean, we have a mortgage to pay, we have pizzas to buy, we have stuff to do. So it's cool to have some money in the bank. It's just maybe not the right thing to have all of your money in the bank or too much money in the bank. Why is that? Because some of the most traditional, the most common types of accounts that the banks offer are CDs. Some of them are money markets, things like that. Maybe even a savings account, which they call, Christmas clubs, things like that. Here's the problem. They don't pay anything. Now, if you've ever gotten a loan from the bank, like most all of us have, you know that the banks charge interest. Depending on your credit, depending on how long you're taking it, could be 5%, 7%, 14%, whatever. Credit cards even worse. What do you have to make on your money just to break even? That's the real question. Now, for the most part, traditionally, the number's around 2.5% to 3%. What that means very simply is if you put $1 underneath your mattress and forget about it for a year, come back a year later, pull that same dollar out, and go down to the store to buy stuff. The amount of stuff that you can buy with that dollar is going to be about 97, 98 cents worth of stuff. You've lost 2 to 3%. Your money doesn't go as far as it did yesterday. That's all inflation is. A lot of people say that they know that. A lot of people say they understand that. But unfortunately, a whole lot of people don't really practice it when it comes to their investments. If you want to keep working for a few more years and then stop working and retire and have a lifestyle, you need to understand that if your investments are not making a minimum amount of return, a minimum amount of gain, a minimum amount of interest to keep up with the times, you're in trouble. You're losing money. So let's go back to that safety thing with the bank products. Why did I say people like to put their money in the bank? Number one reason, it's safe. I've even heard the word guarantee used. So if you put $100 in a savings account, okay? The FDIC is going to protect your money, right? Your money's safe, okay? Your money's guaranteed. If you understand the inflation that I just explained to you, you need to realize this. If you're not making at least 3% minimum interest gain on your money, the only thing you're guaranteed to do is to lose money. You're either making it or you're losing it. There's no in between. Okay? So the last time I looked around at bank savings accounts and even CDs, I didn't even see 3%. What kind of numbers are you seeing? I'll tell you what I'm seeing. I'm seeing 1%, maybe 2% if you lock it up for 5 years, 7 years, something like that. Then I've seen other accounts that are actually worse than that. True story. 3 years ago, met a new client. She had inherited a little bit of money, and part of the money that she inherited from her relative was it was about $35,000, $36,000 in an IRA. Just qualified money, she can set it wherever she wants. So she took that money when she inherited it and got it over. It went down to a local bank, a big bank, won't say the name, but it's a local big bank. And the nice advisor there opened up a little account for her and put her in a money market account, which is basically a checking account. Now, when I met her, I asked her how much interest she was making on it. You know what she said? Because I've heard that answer before. I don't know. Why don't you know? It's $35,000. That's not pocket change. You should know. Well, I just never really looked at it. I just didn't really, the guy at the bank said this. I just set it and forget it because I'm still working. Was that smart? No. But it happens a lot. So my reply was, let's take a look. Let's see what's going on. She grabbed a statement, and I can't remember exactly what the interest rate was because there was a decimal point. There were so many zeros to the right of it before I got to a number. I don't know, it was 1/10,000th of a percent, some crap like that. But here's how it worked out for her. She had a little over $35,000 in the account, and at the end of the year, on $35,000, they paid her 62 cents. 62 cents. That was what they paid her on $35,000. And she had it in there for like 2 or 3 years before I met her. The bank loved her. The bank loves you if you're doing the same thing. Problem is, unless you're going to be a banker yourself, you might need to rethink what you're doing with that part of your money. Let's go back to that guarantee that we started out the video talking about. The bank guarantees my money. Well, we just figured out that with the returns that they're giving, the only thing you're guaranteed to do is lose money. You are losing money if you're not keeping up with the times. You need to understand that. Okay? So let's go back to the other part of the guarantee. FDIC. FDIC, what does that do? It doesn't do the same thing now as it used to. What it does is it will guarantee the amount of your deposit in whatever account you do up to a maximum of, I believe it's $250,000 per account. So that means if you have $250,000 and you put it in your bank account, checking account, savings, a CD, okay, anything like that, your $250,000 account is protected in case something goes wrong with the bank. Is that the end of the story? No, it never is. Did you know that the FDIC only insures your deposit, your initial deposit? Let's say $250,000 you put in the max. So down the road, let's say you set it in the bank and it makes basically nothing, but let's be nice. Let's say 10 years later of you letting the bank use your money, your $250,000 is worth $270,000. Let's say somehow you made $20,000 in a decade on $250,000, whatever percent that is, just hypothetically. So now the bank goes out of business because banks can and do go out of business sometimes. Period. In the story, you've seen it happen. So you've got $270,000 in there, and you start with $250,000. You have $270,000 in there, and because it's FDIC insured, you get your $270,000 back, right? Wrong. The FDIC, as I just said, insures your deposit only. So in the situation I'm describing, you would get your $250,000 deposit back after 10 years. It's been in there, the bank goes under. You eventually get your $250,000 back. Your $20,000 of growth, that interest that they basically gave you, goes away. That's not insured by the FDIC. Did you know that? You do now. By the way, simply just getting even your $250,000 back is not overnight. See, if the bank went out of business, you're not their only customer. So you will eventually get it back, but it might be tomorrow, it might be 6 months later, it could be 5 years later. It could be that many years. So in that scenario, you would have been gracious enough to let a bank hold your $250,000 for 10 years, they go out of business. It takes a further 5 years to get your original $250,000 back. So now it's you gave them $250,000 15 years ago. You have no growth, nothing to show for it. So if the inflationary rate is 3% a year, take 3% year after year after year for 15 years. That's a whole bunch of your $250,000 that you lost in the bank. That's guaranteed to be safe with the FDIC. Now what do you think? I think maybe you should look into some other places besides the bank to put a whole bunch of your money. And again, I'm not saying all of your money. Nothing wrong with having some money in the bank because again, we like pizzas, right? We have bills to pay. But if you have your life savings or a big part of your retirement in the bank because you don't know what to do, where to put it, you don't want to lose it, if that's the reason you're turned to the bank, I need you to understand your loyalty to the bank is putting you in bed with the devil. If you're not going to be paid enough interest to even keep up with the times, you are losing money. They are taking your money. You understand? You are guaranteed to lose year after year after year. And what should make you even more angry is while you're losing, they're taking your money, they're loaning it to the rest of us, and they're making big wins. That's why they love you so much. Big smile when you come to the door, big smile. When you turn around and walk out, maybe they're laughing. I don't know. The point is, if you would like to learn some other places that are adjusted to be more safe than the rest of the world, and they're also adjusted to give you not only enough return to keep up with the times, but even enough extra to actually move forward. If you'd like to know some more options, then I would invite you to come to a live Facebook event that we are hosting. It's on Thursday around lunchtime, 12:30 Eastern. If you'd like to learn why the banks are not the best, if you'd like to learn why the banks are not only not the best, but other places are not the best, more importantly, if you'd like to learn what some of your options are, that's the most important thing, and education. So you can see really what's out there and then do the comparison yourself. If you want to learn what else is out there besides your bank, I invite you to come to the Facebook Live event. You can simply click on the link above this post. It'll get you registered. And then if you attend, you'll get some great information. I'm also going to open up a live Q&A for about 10 or 15 minutes where you can actually buzz in and ask me about your specific investments, whatever they are. David, what do you like about this? What should I know about that? Is there anything that you know of that might sound better to me? It's just information. Information you probably haven't heard. Information that will probably help you make a better decision. If not today, certainly tomorrow. Because again, especially now with COVID taking everything away from us, the last thing you need to do is to allow somebody to take what you've worked for. So that's what we're here to actually try to help you out with. We want to give you the education. We want to give you the opportunity just to learn more. So again, I invite you to join us for a live Facebook event. Click the link above this post. We'll get you registered. We'll talk about what you have, answer any questions you have, and we'll just go from there. Thanks. Have a great day.